Hello, everyone, and welcome back to the last session of our risk management course. My name is Ali Mortezavi. I'm the head of education at Errante. I'm so thrilled to have you here in this webinar today, where we are going to conclude somehow what we've discussed in our previous sessions. So if you've been with us in the previous sessions, we actually talked about the fundamentals and advanced techniques of managing risk. But today, we are taking it even further. We are diving into the power of data and predicting and controlling risk. Because you might know the best traders in the world don't just manage risk, they predict it, quantify it, and adapt their strategies accordingly. So in this session, we'll explore how real market data, volatility models, and statistical indicators can help us make smarter decisions and reduce unnecessary exposures. Before that, let me just introduce our broker, Errante, which is an online broker committed to providing top-tier services and building lasting and trusting relationships with clients and partners. You can find a lot of good details about the broker on their website. And I would like to share the link also with you, so you can just maybe search a bit about this later after this webinar. Yes, here is the broker's website. You can easily just go to errante.com, and in any region in the world, this is a regulated broker that which is working with top-tier banking, and you can make sure that your transactions will be safe and secure, and you can also take advantage of the high cutting edge technology in different trading platforms like CTrader, MetaTrader 5, 4, and also TradingView. So yeah, I promise this is just a very short introduction about the broker. However, it's important to acknowledge the risk involved in trading financial markets. And because of that, please be aware that this webinar is for educational purposes only and does not constitute financial advice of any kind. So because we encourage all traders to conduct their own research, apply proper risk management techniques, which is the topic of our discussion today. Okay, let's talk about something that is often overlooked: trading data and risk management. Many traders think risk management is only about setting a stop loss or managing trade size, but the reality is deeper than that. If you don't measure and track your strategy's performance, you're making decisions based on, let's say, emotions rather than data, and that can be dangerous for sure. And you see, I have 3 parts in on my slide here, and that's and they are going to answer this big question: why are trading data important in risk management? The first thing is that most traders do not know how much risk their strategy carries. So ask yourself, how much does your strategy risk per trade? What's your average drawdown? If you can't answer these questions with numbers, you're not managing risk effectively. Risk is not just about avoiding large losses, it's about knowing the probability of different outcomes in your trades. So without data, you are trading blind. And many traders also evaluate their strategy based on emotions or few recent trades. Have you ever had a winning streak and felt invincible, or thinking your strategy was perfect? Or have you had a few consecutive losses and suddenly questioned everything? This is a common trap. We tend to judge our strategy's success based on the last few trades, but that's not how probabilities work. Every strategy is winning and losing streaks That's okay, but the key is looking at long-term data, not just the handful of trades. And that's why we need data, because if our judgment clouded by some emotions of our recent experience about our strategy and trading journey or something like that. So if we have the data set, so we can just take a look at them and make sure we are on the right path, or we can just somehow recognize that we are on the wrong path, so we will be able to get evidence on that and let's say somehow try to change it. And lastly, but not least, most traders abandon their strategy after a few consecutive losses. It might happen to you after 3 or 4 losing trades. Many traders start changing everything, tweaking indicators, switching time frames. They are looking to the problem from the very wrong angle. They think they should master all market conditions to be successful. And so they start changing everything. But here's the problem. Most traders never test whether their strategy is actually profitable in the long run. So if you change the strategies too often, you never allow a system to play out its probabilities, because when you have, for example, a chance for to have a winning trades, okay, the losses are always a possibility. However, the way you manage these uh, losses and let's say wins, that makes the difference. So this is where keeping records and analyzing historical performance becomes essential. However, we explain. So that's the reason we need to scrutinize risk management from data points. Okay, but there are some different sources. Okay, the question here is, okay, what data we're talking about? So if you don't have a structured way to assess risk, you're essentially flying blind to the market. So we need a systematic approach. And this slide introduces 3 key sources of trading data that help us with that. First is past trading data. Okay, the first and most obvious data. Everyone, I guess, is familiar with that in this webinar, this room. So this is a past trading performance. Every successful trader tracks their win rate, risk to reward ratio, drawdown levels over a large sample of trades. Why? Because without this data, you have no idea whether your strategy is working or not. So if you don't analyze your past trades, you could be making the same mistakes over and over without realizing it. And that's why you see professional traders treat past trade data like a business report. They're always proud of their performance based on their business report. They just want to show you, let's say, the statement, to show you all the numbers, show you how they have been careful about their drawdowns or something like that, and they are bragging about these kind of stuff. So you need to know if your trading model is profitable in the long run. And second source is the market volatility. Yeah, market volatility is something, actually, it's a data source for us to manage and control and mitigate and even predict our risks. Uh, It's crucial for setting stop losses, which is a part of the game, adjusting trade size, and of course, defining realistic take profit targets to get into the earth of the chart, price chart. We really need to know what we are discussing which market we are talking about. We're looking at how much volatility involves in at the time we want to trade. So we use the average true range ATR to measure volatility. And ATR tells us how much a currency pair typically moves within a given period. And we discussed it in our previous webinar uh, about how we can use the ATR and to make sure that our stop loss based on the chart could be would be proper. So we can assess it with ATR. If ATR is high, it means the market is highly volatile and we need wider stop losses and potentially a larger risk to reward ratio. And this is a way that we can assess if the setup that the chart is offering us worth it is or not. So if ATR is low, the market is calm, and tighter stop losses with lower ROI may be more effective to cut losses sooner than later. So this ensures that our risk management is dynamic rather than a fixed one-size-fits-all approach. And the third one is correlation between currency pairs. So if you somehow like to trade in different assets, like your currency pairs, gold, or indices or something like that. So it would be very useful for you to look at the currency pairs or assets correlation. Many traders make the mistake of trading multiple pairs without realizing they are highly correlated. And we showed you in our past webinars that you can use a CC, that's the correlation coefficients, which is a Pearson ratio, Pearson number in trading view. And that will be very helpful to get a better understanding about all the, let's say, about the correlation at time, at the moment, between two assets. Okay, to make it a bit clearer here, let me just bring my trading view here. So let me just make sure if everyone can see it. Cool. Okay. Yes. You see here when we are talking about the volatility or using something like a Bollinger Bands or ATR as just because of this. Let me just hide this indicator and then the average true range, which is a very great way to understand the market volatility. And you see here, for example, when we are on a gold chart in 1 hour time frame, you see the ATR is almost about the 6.22. It means $6.22 is something that we can expect the market gonna volatile in 1 hour, one candle. So how we use it to assess our, let's say, stop loss and TPs it's just a recap from the previous session. So I'm gonna just go through it very quickly. Here, for example, let's say you look at the chart and you use this moving averages. You see the market's gonna coming down somehow, and then you see a break below the last, let's say, market bottom here, and then you are going to short the market anyway. You can put your stop loss here at this level. And one thing which is really important is to see how far is this stop loss from your entry. For example, from here to there is a $13 somehow, okay, let's say. And then When you look at the ATR, you see the ATR is 6.22. It means your stop loss is almost more than twice of the ATR. It means in a natural market, the sudden volatility or market spike or something like that is not going to threaten you, your stop loss, because the healthiest stop loss is at least 1.5 times or 2 times of the ATR. It means it's a good stop loss to take. Let's say after all of your market analysis and everything, we are not discussing the strategy or technical analysis, we're just discussing the risk management. Okay, in that case, this setup is offering you a very healthy, let's say, a trading opportunity, and you have a good place to put your stop loss at the last market top when you want to short the market, and then you can wait maybe for the next candle to see if it can keep it below the last market bottom. So that will be a sell opportunity for you. And here is another example. For example, in lower time frames, let's say here you see the ATR is about the 2.37. It means the $2.37 is the amount or the range we can expect the price to move in each 5 minutes. How we use it for our expectations regarding take profit levels. So, okay, so if you want to set your GP, for example, in $10 distance from your entry, it means you're not going to expect it to happen suddenly next move in the market. You're going to think about the possibilities and the reality of the market, that it's going to take time maybe to reach that target, because the your target is almost 5 times the ATR. So it's not what that market can achieve just in 5 minutes in 1 or 2 candles. It needs at least 4 or 5 candles. So you can prepare yourself emotionally first of all, and then you can have a very realistic expectation about the chart, or maybe you may just refuse to put such a long take profit according to the ATR in this case. However, there are times that, for example, here you see the ATR is 2.39 right now, and if you want to, for example, short the market at this level, and if you want to just set your, for example, a stop loss for somewhere here, you see your stop loss is not twice or 2 times the ATR, so the 2.40, and your stop loss is almost only $4. So it can be a very tricky stop loss. So wise, or let's say some risk traders with less risk appetite may just don't take this, may not take this trade because they see the ATR is something like a 2.4 and the stop loss is less than a 2 times the ATR. He said, okay, any spike, sudden spike in the price can just hit my stop loss. And if I want to put my stop loss further, so this setup is not suitable for me. So it's better for me maybe to wait to get a better setup. So this is how you will get a measure to assess your stop loss, your chart setup from risk management angle, not from the technical analysis or fundamental analysis or news based or something like that, just from the risk management perspective. So to manage risk effectively, we need to rely on data, not emotions. And these 3 sources, past performance, market volatility, and correlation. Okay, talking about the correlation, let me just show you also that one. That will be very helpful, I guess. So if you go to indicator or search CC easily, you will get the correlation coefficient, which is On gold, for example, you can choose anything, something like the dollar index, let's say. Let's say this US dollar index here. And then if you apply it here, it's going to, the Pearson number. This is a ratio between 1 and -1, and it shows how two assets are correlated. For example, if it's near the -1, it means they have a negative correlation. It means when one goes up, the other goes down. Okay, and when it's near the 1 +1, it means they have a positive correlation. It means when one goes up, the other expects it to go up. Okay, this is a and besides all the myth that you are hearing that the dollar and gold have always negative correlation, when you apply CC in your chart, you will see in short term, not a long term, but just in short term, there are times, for example, this is 1 hour chart for gold, there are times that the correlation ratio is 0.56, near 0.6. It means they are somehow in a positive correlation with each other. And this is mostly happen when we see gold in a range or after a big rally, something like that, or when it's about to start a new rally. And it depends on the market situation, the global risk appetite, and the economic factors, the let's say macroeconomic factors from different economies that can play a very essential role to make the correlation, to let's say sentence the correlation between gold and dollar index. For example, here you see there were times during the February 21st, 24, and 25, so about the 3 days, the gold was almost in the positive relationship with dollar index when it was a range market. And this is something that you can understand if you are going to have multiple positions on the assets which are positively correlated to each other. It means you're increasing your risk exposure. So if you want to trade different assets, it's really recommended to take a look at the correlation. And what type of correlation? The correlation on the time frame that you are trading. For example, here, if I'm trading on 1 hour time frame gold chart, it's not very okay, for example, to look at a daily, because on a daily basis, you see there is mostly negative correlation, as books say. But when it comes to reality and when I put money on this stake, so it means I have to be more careful about the correlation, because there are times you see the dollar index dropping and the gold is dropping as well. So there is a positive correlation between them. So, and this is this is applicable on other assets like your USD, GBP, USD. You will see they are mostly positively correlated to each other. So if you want to increase your risk exposure, you can go for multiple positive correlated assets. Or if you want to decrease your risk exposure, you have to let's say take position on assets which have a negative correlation. So that's why we look at this volatility and currency per correlation to make it alive. It's not just something like a theory or book. It's like a very live journal that gives us the ability to somehow assess our risk in a real time. Okay, so let's walk through a structured way to analyze our trading performance, risk exposure, and maybe potential weaknesses. The question is, how can we analyze trading data to predict future risk? There are a couple of ways or steps we can take. First of all, you need to extract past trading data from trading platform. It's a trader trading view. We can put all the our trading journal in Excel, and we can use that. This is the first thing. To evaluating risk, so we need to collect past trade data. This can be done using platforms like MetaTrader. I showed you in our previous webinar. And the next step is analyzing win rate and risk to reward ratio. So once you have the data, the next step is to analyze two key metrics. First, win rate. What is win rate? The win rate is a percentage of trades that are profitable. So, for example, if you apply your strategy in 100 trades, and then you see that 70 of them were profitable, it means you have a win rate of 70%. I mean 70 trades. So this is a good thing to know, and it means how many trades, in relation to your overall trading strategy, you can maybe close in profit. And next one is the risk to reward ratio, RRR, that we discussed it in a very great detail. And if you remember, it's a ratio of your potential profit compared to your potential loss. It means when you are going to risk $1, how much you're going to gain. So it's a very good way to see if it is worth it to take that trade. Because if not, why should you put, let's say, $1 at risk when you expect to get less than $1? That's a big debate. Okay. And I'm going to show you how you can answer this big question that you might have heard a lot across the social media, that many forex gurus talking about this. Okay, just go for a 1-to-4 risk to reward ratios, 1-to-5 risk to reward ratios, and don't risk the money which isn't worth it. But we will see profitable strategy doesn't necessarily need a high win rate. This is something, yeah. A strategy with a 40% win rate can still be a profitable strategy, doesn't necessarily need a high win rate. If the RRR is favorable and vice versa, you can increase the probability of your strategy to end up in profits with using an adjusted lower RRR. So you see, this is something like two sides of a sword, and you need to just make a balance between them. And there are, of course, the next step, step 3, is evaluating maximum drawdown, or MDD. This is something that measures the largest peak to trough drop in capital. And why is this important? Because a trader can have a profitable strategy, but still face large drawdowns, causing them to abandon a good system too soon. So If your drawdown is too high, for example, over 30%, which means you are doing good with your strategy. Maybe on average, you can make $100 or $150 per trade. By the way, when you lose almost $500 or something like that, or $700, and suddenly one drawdown can erase most of your profits in a week, or in 2 weeks, or in a month. And this is a big issue. So, okay, um, as far as I can understand the market, my strategy works very well, but when I do one minor mistake in my trading, so it erases all the profits I've made since, let's say, beginning of the month. So this is a really important thing if you look at this from this perspective. And then we are going to add something, the step 4, examining market volatility and correlation. Risk isn't just about stop losses and position sizing, it's also about volatility and correlation, as we discussed. So if your trading strategy performs well in calm markets but struggles in high volatility, you need to adjust your stop loss and take profits based on ATR. So if you are trading multiple pairs, understanding correlation helps avoid taking multiple positions that increase overall risk instead of diversifying it. So this is a thing that when the next time that you just review your journal, your trading journal, to see why you took that trade or something like that, to evaluate yourself, to judge yourself in a good way, you can just look at the chart to see, okay, at the time you took the trade, how was the volatility in the market? And if you look over many trades in your journal to be meaningful, you can get to a new boundary of yourself or your trading skill. That means you will understand you are a trader for volatile markets or you are a trader for calm markets. And this type of things can give you new insights about your trading styles. And here is a numerical example. Let's say you have 100 trades with a 55% win rate and 45% loss rate. So the average profits per winning trades is 120, as you see, and the average loss per losing trade is $80 only. So this means your system is profitable over time. But if drawdowns, for example, exceeds 30%, it's a red flag. You need to reduce position sizes to control risk. So you can see, opposite all of our hearing about the holy grail in financial markets, finding a perfect strategy, 100% working strategy. See, it's not really all about the strategy. It's mostly about the risk management, because with a very average trading strategy, the win rate of 55%, you will be able to make money in Forex. And this is something like magic of finance, and risk management. And in our next part, I'm going to just walk you through these questions to answer these questions actually. How can we determine if a trading strategy is truly profitable in the long run? How can we measure the potential profit relative to possible losses? And what is expectancy? The answer to these two questions is the expectancy. It is a mathematical expectation in trading. And how can we calculate it? It's going to be, I guess, very helpful. Okay, let's break it down step by step. Expectancy is a mathematical formula that tells us how much we can expect to win or lose per trade on average. The equation takes into account four key variables. As you see here, this is the equation. Average loss multiplies by the percentage of our losses. And on the other side, we have average win multiplied by the percentage of our wins. So if we deduct the wins, if we deduct losses from the wins, we get the expectancy. What does it mean? Win percentage. Any parameter here I'm going to explain. How often your trades are successful. Average win tells us the average profit per winning trade. The average during the session over 100 trades, for example. Loss percentage saying how often your trades lose. So it means, okay, if I apply this strategy, it's a 50-50. 50% I have a chance to win, and 50% I have a chance to lose. But if I improve or use some other, let's say, more tools for confirmation, for, let's say, the higher time frame trend direction or something like that, I will be able to improve my strategy, and it means I'm going to improve my win percentage. So if I apply my strategy, it means I have a chance of 70% to win, to be profitable. And on the other side, the odds are only 30%. But the other question is how much I'm going to win or to profit or to gain on average. So now why is this formula important? Because it tells us whether our trading strategy is actually profitable over time. If expectancy is positive, the strategy is profitable in the long run. And if your expectancy is negative, it means you will lose money over time. Even if you have some winning trades, you have had some big wins, but still you are losing. Something is wrong and your system is leaking. If your expectancy is zero, that means your strategy breaks even, meaning you're just covering costs without real profit. And I hope you remember how you could get, let's say, your report. Here, MetaTrader 4 is a very easy, save as detailed report. First of all, you need to set a good time period for the last 3 months, last month, or history or custom period. Or if you are a high frequency trader, you can just choose today, last 3 days, something like that, and then you will get the history of all of your filled positions, all of your executed orders here, and then you will able to easily just save let's say detailed statement, and that's it, you get it. And where you can find all of these numbers here, at the bottom of this file, you will see your gross profit, you will see your expected payoff, which is the expectancy we were talking about. For example, for this account, you see the graph here, And you can see the total trades were 76, excuse me. The profit trades of total was 82%, which is a win rate, and loss trades was trades were 17%, which is the uh, loss percentage. Okay, and about the averages, you see the average profit trade is 335, while the average loss trade is 428. So at the same time, we have an 82% successful strategy. We see here is a red flag. Our average losses exceeds our average profits. So it means when we lose one trade, we lose 1.5 of our successful trades. And this is not something good about this account. However, all in all, you get to the expected payoff of $200. And what does it mean? It means if I apply just the strategy I uh, have been using for a while for my next trade, there is a good chance to get $200 almost profit. So the system is profitable, and this is a good thing to know. And here also you see we have a maximal drawdown, so the MDD, and it's about the 31%. So this is another red flag. And if you look at these loss trades, I showed you the average loss trade, it means this trader is taking considerable risk. So it's not a conservative way of trading. It's a very aggressive way. It's a 31% maximal drawdown, while the account the strategy is successful over 82 or 83%. However, it's a very risky, let's say, a strategy that this trader is using. But this system is making money. So you can count on it. So one thing you can do right now is just jump on your trading platform and choose. And just take these steps and get your report and find out your expected payoff. And then you also have, you can also just adjust the time period to see in different, for example, month of a year, how you were trading in different seasons, for example. And that would give you a good insight, not also about your mechanics, also about your emotions. So you will see when you trade better. And now you can have proof of that, because here you have all the times, all the dates, all the, let's say, results of your trades. So if you can just use it with other information about yourself. Okay, okay, for example, this trade was executed on the 10th of the March, and I was doing blah blah blah, so I was in a very good mood, so I did this, I did that, so that's so you can see which trading style matches you in better way. So that would be a good thing to know about yourself. And here is, of course, uh, and let's say a real numerical example. And I want to give you some insight about this. In the first scenario, let's take it from here. We had a trading strategy with 100 trades, a 40% win rate, and an average profit of 150 per winning trade. And meanwhile, losing trades occur 60% of the time. So you're losing trades. Yeah. Let me just maybe my laser point. Yeah, here you see. Averages $100 loss. So when we plug these values into our formula, we see that the total expected profit and total expected loss cancel out, leaving us with an expectancy of 0. Just means that over time, this strategy will not break even. It will only break even. We're not going to make money. By the way, you see we have for example, someone can tell you, oh my God, I won $150 in my last trades. So my strategy is working very well. And now you know the numbers, you can evaluate that and you see the result and you have the expectancy and you see this is a 0 expectancy. So this is just a break-even strategy. It's not something, okay? So many traders fall into the trap of thinking that if they have, for example, a large, let's say, profits, so they are going to be profitable, but that's not true. Opposite to that, they usually, because of this mindset, they usually put a lot at risk in one trade, and they don't, let's say, keep in line with the 2% rule that we discussed in our first session in this course. So they eventually end up with more losses rather than gains. So let's see how we can adjust our strategy to turn it into a profitable one. That takes us to the second scenario. In the second scenario, we make a small but significant improvement. We increase our average profits per winning trade from 150 to 200. And the formula changes. Now, when we calculate expectancy again, we find that the new value is positive, almost $20 per trade on average, which means this strategy is now profitable over the long run. And what do we mean when we are saying we increase our winning trades on average from 150 to 200? It means we are adjusting our trading strategy. We improve our technical analysis, or we consider particular time frames or particular, let's say, market hours to trade, something like that, to increase or we put, it's not just simply put our take profit higher than before, because depends on the chart. If your setup is not really that rewarding, and it's not going to get you there, the higher TP. Vice versa, it might cause you lose money because the price, for example, gonna go in a way of your analysis, but not that far. So then it might reverse and you end up with losses or just a break even. So it's not this. It's adjusting your trading strategy based on the other factors, adding more confirmation, use new indicator, use new time frame, to change something. It's not just simply increase, or let's say increase your TPs. But here is a takeaway, as a conclusion. By increasing the average profit per winning trade, expectancy becomes positive, meaning this strategy will be profitable over time right now. So we can expect to make money using this strategy. Now, we've now established how expectancy can determine whether a strategy is profitable, breaks even, or loses money over the long run. Let's summarize the three possible outcomes. When we have expectancy greater than zero, it means that the strategy will be profitable, even if we suffered from some big losses recently, it doesn't matter, okay? So as a trader, we just put our emotions aside and we look at numbers, we look at expected payoff on our statement, we see it's positive, it means okay, I have to control my emotion right now because my strategy is working, and here is the proof of that. So if expectancy is equal to zero, it means then over time you this strategy will not make you money. Your gains and losses will cancel each other out, leading to a break-even result. And if expectancy is negative, the strategy is losing money over time and needs improvement. So this is a very big red flag, very important, very serious red flag that you have to stop using your strategy right away, jump on a demo account and scrutinize until you can find out what's wrong with your strategy. Does it work in volatile market, or you use it in the wrong way? Why the indicator signals with delay or something like that? And then you have to stop trading that strategy because you're losing money. Now, how can we improve our expectancy? This is a good thing. This is like a diagnosis method, and we can just go through our expectancy, a journal, losing all of those numbers to see, okay, how am I doing? So what are my weaknesses, and how I can improve them, how I can fix them. First, we can increase our win rate by improving entry timing, using better confirmations and filtering out low probability trades. For example, you see sometimes your average loss is higher than your average win. So it means, oh my God, I am taking unnecessary trades that's let's say ends up in losses. So why? Maybe I'm over trading, so I have to reconsider that and maybe take just few trades, but the good high quality trades. When you see your strategy is working, for example, your win rate is high, okay? When you have a good win rate and but you're not making that money, or you have almost break even expected payoff, it means something is wrong with your TPs. So you have to evaluate if you are trading in very volatile market, very range or call market. So you might reconsider the condition you apply your strategy in real time. So you might, for example, use different methods to identify your TPs or to set your TPs. Or if you see your drawdown is too high, is too much, you might reconsider your stop losses, what rules you use for your stop loss. Maybe you do a very dangerous, you have a very dangerous habit, then that's not using the stop loss. And this is something you have to do. Really something about that. You have to fix it, because without a stop loss, you can't measure, you can't calculate your right position size. You can't calculate the amount you're putting at risk, and the money is the most important asset in the forex market. So, and the third one among all of these ways that I'm just let's say brainstorming them, we can reduce average losses by setting more strategic stop loss levels, avoid unnecessary stop loss stop outs due to market noises. And here is an example. For example, even if a trading strategy has a 40% win rate and 60% loss rate, means it's a very it's not a it's a very ugly strategy, yes. By the way, however, increasing the risk to reward ratio or from 1.5 to 1 to 2.5 can turn it into a profitable strategy. That's why some people are saying, okay, I might be wrong. And by the way, I'm going for just very high probable scenarios with a very long RRR. So that case, I will win or I will just close it at break even. Doesn't matter, but I'm just want few trades per month, maybe less than 10, let's say, trades, but I just need 2 winning trades out of all of those 10 trades. So that would be a fortune. And let's talk about one of the most critical aspects that we discussed it a bit as drawdown. What exactly is drawdown? Drawdown is a percentage drop in a trader's account balance from its highest value to its lowest point. So it essentially measures the worst case scenario for strategic capital loss. And if, for example, as an example, this is a reduction in traders' capital from peak, the highest point. By that, what we mean is if you go to your statement, you see, for example, from here, this top, we get to this bottom low, and this is a drawdown. So almost about the 30% of the capital that time. And then when the account, you see the account moved better in the past, and then after a while we had something like this, but in terms of the percentage it was less than the previous one. Why? Because here we have more capital there, so more near the 12k, but here is less than a 5k, it's almost a 6k, let's say. So if your peak capital was 10,000 and it dropped to $7,000, so your drawdown would be 10,000 minus 7,000 multiplied by 100 means 30%. So now, why is drawdown dangerous? Drawdown is really dangerous because, you know, maybe more drawdown here can could have end up to stop out even. Yeah, why not? It's always possible. So the deeper the drawdown, the harder it is to recover. Please write this down. This is a rule. This is a magical rule. And put it on your trading desk. If your capital drops by 50%, you don't just need 50% profit to break even. You actually need 100% just to return to where you started. So that's why drawdown is very dangerous. And as you have heard, the Warren Buffett, the legend of finance and investing, is saying there are 2 rules to make money in financial markets. The first one, if you want to make money, don't lose money. And the second rule is to remember the first rule all the time. Yeah, so it's like a lazy old guy joke, but it's true. Yeah, it's definitely true. And the other reason is that large drawdowns put traders under intense psychological pressure. So I think we are on the same page about this. We've experienced that before. when we lose a lot of money, it leads to emotional trading, over leveraging, and impulsive decisions. Many traders panic and either quit trading too soon or take excessive risks to recover losses as fast as possible, often leading to even bigger failures. So, what's the solution? Managing drawdowns effectively. And here is the nice example, I guess. If you account experiences a large drawdown, recovering from it becomes exponentially harder, not just harder. Let's analyze a table here. If your account drops by 10%, let's say, you only need an 11% profit to recover, and this is manageable. But if your account drops by 30%, you need at least 43% profit just to return to where you started. And when your account dropped 50%, it's even worse. You must double your money, your tradable money, just to break even. And the worst case scenario here is see the 80% drawdown requires a 400% gain to recover. So if you see the hardship, if you see how painful it could be to gain 400% to just be where you started, it means it's not worth it to risk a lot of money on each trade. And if you stick to that 2% rule that we explained in our first session, I guess, and second session, you now know why that's really, really a lifesaver. Because when you put only 2% of your capital at risk in each trade, means you need at least 5 trades, consecutive losing trades, yes, to get a 10% drawdown. And this is hardly happens. And even for the 20% to 30%, or no, it won't be possible for anyone, maybe. So that will be another contest that you can have with yourself. If you, for example, use the 2% rule, you will not be able to stop out to blow up your account. It will be impossible. See, just opposite, using the odd against it. No, this is the thing. So if you put a 2% rule, it means you need at least more than 10 trades to be losing, to get a maximal drawdown of 20%. But if you just put 10% of your trades in each trade, after 4 trades, you will be here, and then you need 67% recovery to get to where you started. This is much harder. So it's really, really, really wise. And this is why professional traders focus on consistent risk management rather than chasing quick profits. So if a drawdown does occur, traders must have a structured recovery plan. You are not gonna just cover it quickly in our few trades, if your next few trades. So you need a plan to rebuild their capital without taking reckless risks. Oh yeah, I have this here. So the capital recovery plan is really important. How we can create one. Let's see how to reduce and prevent these high drawdowns. There are some methods to help here. The first step is to control risk per trade. As I said, always ensure that you never risk more than 1 to 3% of your capital on a single trade. So if you experience a series of losses, reduce your trade size even further to prevent deeper drawdowns. And the next one is position sizing, which is another key factor. Many traders fail because they continue trading with the same position size. For example, always, okay, I'm trading have a lot each time I want to trade gold. Okay, it's not good. It's not right because the distance of your stop loss from your entry could be different in each trading setup, in each particular trading setup. So it means you're putting different amount of money at risk each time. You know, rather than just fixing the size of your position, you have to fix the amount you put at risk, because the money is more important than the position size. Yeah, because this is your money and you have to take care of your money. So you have to set a limit for each trade. I'm not gonna risk more. I'm not gonna lose $200, more than $200 in each trade. If you have, for example, 10K account. So that case, you're saying I have a nice clear limits for myself, and I'm going to determine the size of my position based on this and based on the setup that the chart offers us that we discussed in our second webinar. And then, of course, have a grasp of market volatility in real time when you are trading on a chart by using a dynamic, let's say, indicators like ATR to set your stop loss in a very dynamic way that helps you avoid getting stopped out too soon or too late. So instead of setting a fixed stop loss, adjust it according to market volatility to allow room for price fluctuations, especially if you are using a trailing stop loss. It's really also important to look at ATR first. Don't set your trailing stop loss in a very random number. You know, you have to look at the ATR, because by the way, as I said, any random spike or fluctuation in the market can just hit your trailing stop loss. So make sure your trailing stop loss is really larger, at least 3 times larger than the average ATR, average true range. And the next tip is avoiding the biggest mistake, over trading. Many traders after a loss attempt to increase trade frequency in an effort to recover losses quickly. And this often leads to more emotional decisions, even bigger losses instead of recovery. So when you lose, just take a deep breath and get away from your desk, from your monitor chart and whatever you are trading on, and just forget about it for some hours, and then recover your emotions and get yourself balanced, and then take back to your seat and start over. Okay, to survive and thrive as a trader, you must focus on risk management first. Managing drawdowns effectively ensures that you stay in the game long enough to take advantage of profitable opportunities. Okay, so start trading and review data. Yes, for a recovery plan. Okay, when you lose a lot of money, the key to recovery is not to chase losses, but to have a structured approach. Okay, so that's where capital recovery plan comes in. It follows 5 essential steps. Let me just conclude this, and then we're going to wrap up this webinar. First, stop trading and review data. Pause your trading activity. Take time to analyze what went wrong. Was it poor strategy, market conditions, or emotional decisions. And then reduce risk and trade size. Lower your risk per trade to protect remaining capital, and reduce position size to avoid further damage until you get to a good mood. And of course, limit the number of trades. Do not jump back into high frequency trading. Trade selectively, more selective than before, only taking high probability setups until you rebuild confidence and capital. The next tip is analyzing winning and losing trades. It's a very good way to identify which setups worked and which one didn't. Review your losses and try to learn something about it, about your trading style, about your indicators, about your strategy, about your risk management, something, and try to diagnose your mistakes. Assess whether your trading strategy needs adjustment or something, and then gradually return to normal trade size. So you reduce your trade size first, and then when you build up your confidence again, so you feel comfortable to increase your trade size. And once you regain consistency in performance, slowly increase trade size back to normal level. And the goal is not just recovery, but sustainability, because if you choose to be a trader, you're going to do it for a lifetime. So you have to do it in a way that you are able to do. So a well-structured recovery plan separates professional traders from emotional traders, because everyone loses money. It's not something strange, it's not something weird, it's not something exceptional happening to you only or to me only. Everyone, even the best performed, let's say traders, hedge fund managers, etc. in the world, they lose money. But the thing is that instead of reacting to losses with panic, professionals use data-driven decisions to rebuild effectively. Okay, if you have any question, I would be more than happy to listen that and maybe address if I know the answer. Okay, there's a couple of questions. One of the very frequent questions here, how do I prevent large drawdown? I mentioned keep risk between 1 to 2% of your capital per trade only, and to set a proper stop loss, look at ATR based indicators like the ATR itself, and then measure the distance between your entry and stop loss and compare it with the ATR. It should be at least 1.5 times or 2 times the ATR, the current ATR. Okay, and okay, we have another question. Should I change my strategy after a couple of losses? Why not? You know, I'm not saying that you shouldn't change your strategy. It depends on many factors, but I would say unless data confirms it, it's better not to do that blindly. You know, a few losses don't mean your strategy is broken. Even winning strategies go through drawdown, so it's very, very natural, very okay. But you have to take some steps before. First, review expectancy. If your expectancy remains positive, your strategy is still sorry, your strategy is still valid. So uh, there's nothing wrong with that. You just need to calm down yourself. Okay, you're gonna make money very soon. And then the next step you can take is backtesting and analyzing. Check if the losses are part of normal variance or if market conditions have changed. For example, there was a news announcement, there was an end of a session, the beginning of a session. For example, US session uh, begins about the 2:30 server time these days till the end of March. Okay, and then that might be something unexpected to you because you used to look at the US session about around 3 in the afternoon, 3 p.m. But now it's the about the 2 to 30. So it would be something like an unexpected event for you. You see how the market gonna act crazy, and it's very obvious if you look at the chart here. For example, on gold, I have uh, if you look at before the opening session, for example, here is the ATR we have here. Look at the ATR. I have a data window. Data window is very useful to show you the value of each indicator you have, the current time, and also where your cursor is. So here, look at the before market open, about the noon European session. You see the ATR. Here you can see the ATR. It's about the 60 cents. 60 cents, 60 cents, 58, 53, 58, 60 cents, 70, 80, and see what has happened. It's increasing. You see 85, 85, and when we get to the opening, it's about the 1430, you see it's increasing to $1. So this increased volatility is almost twice before this session. So it should have some meaning for you. It means the stop loss here, for example, $1 was working properly. It's not gonna work here in this market. We are at the two sides of this session. This is this session opening, for example, 14.3. And before, because of the ATR 64, okay, the 1.2 stop loss distance was okay. But here, after opening the US session, no, the ATR is 1.20 almost. So you need at least $2. It means your risk is increasing if you don't analyze the market correctly. It means you're putting more money at risk, and you are not going to do that. So you have the wider distance for your stop loss compared to your entry point. So it means you have to decrease the size of your position to be at the right path. So you have to take care of all of these reasons when you just, let's say, review your performance. So in that case, you see if that's part of the reasons of your losses, you can adjust risk management, not the strategy. So before changing your strategies, reduce position sizing and evaluate execution errors. Cool. Okay, and with that, we come to the end of today's session. I hope this webinar has provided you with valuable insights into risk management expectancy and how to structure a more robust trading plan. Okay, a big thank you to all of you for your time, engagement, and great questions. If you have any further queries, feel free to reach out through our platform or join us in our next webinar next week, you're going to find out sorry, on our website, and or you can just contact the email you registered with, and we will be more than happy to answer and address your questions. So stay consistent, manage your risk wisely, and trade smart. Until next time, happy trading. See you in the next session. Thank you. Bye-bye.